Hey, this is Tom, and I think a major catastrophe is about to hit the stock market. Now, listen up. This hasn't happened yet. You do have time to prepare, to plan ahead, to adjust, so don't panic. There's going to be a very nerdy video, so it's not going to be for everyone. I get it, but if you're a regular viewer on my channel, this video is a must for you. Now, look, something really bad is happening right now and is mostly getting ignored by mainstream media. The rate of change of the 10-year bond yield is extremely alarming right now. The bond market is absolutely your best way to look into what's actually going on underneath the hood of the stock market. And right now, it's literally screaming, watch out, get the freak out of the way. Now, this topic gets some coverage on mainstream media, but not nearly to the extent it should, because this is absolutely critical. Now look, the 10-year treasury rate is going up aggressively. And it's currently at 4.2%, which is as high as we have seen it in the past 14 years. At the same time, and that's also very important, the 2-year treasury rate is dropping hard. It's currently at 4.5%. So why is this a big deal and why you should even care about that? Well, you see, yields and prices have an inverted relationship. They're kind of like a divorced couple. You know what I mean? But basically, they actually are inversely correlated. So the higher the price of the bond, the lower the yield and vice versa. Think of it like a used car, right? The yield represents the quality of the deal you got for that car. For example, if you overpaid for a shitty car in bad shape, the yield on that deal would be very low, even though you paid a lot of money. But if you get a great price, cheap price for a terrific car, the yield will be higher even though you pay less money. The more you pay, the less the yield of the bond. And the less you pay, the more the yield of the bond. Now, why is the 2-year yield is dropping while the 10-year is skyrocketing? And why is this so bad for the economy and the stock market? Obviously, because that's what we're here for, right? So the reason is that the price for the 2-year bond is rising while the price for the 10-year bond is dropping like a stone, which means the demand for the 2-year bond is absolutely high when nobody wants to touch the 10-year bond with the pole. Nobody wants it. Demand is dropping for the 10-year. So we know the demand for the 2-year bond is going up while the demand for the 10-year is going down. So what? Well, remember this rule. The longer the bond, the bigger the risk. The risk of holding a 10-year bond is bigger compared to holding a 2-year bond, just based on the fact that you have 8 more years of uncertainty to discount. Now, one thing to know about risk, that it is not always a bad thing. At good times, risk is seen as a good thing, while in times of uncertainty, risk is usually avoided as much as possible. That just makes sense, right? So now, you finally see the whole puzzle, not just the each and every piece. There's a flight from the riskier 10-year bond all the way to the 2-year shorter bond, and it's getting more and more aggressive. Now, that means that the market is extremely concerned about a recession, and that fear have been growing stronger and stronger in the recent weeks. That means only one thing. There's more rate hikes coming down the pipeline because the Fed's limited success in slowing down inflation. So with tighter monetary policy ahead, a deeper recession is definitely in the cards, and the bond market is a great indicator of that. That's what I'm trying to say here. But the real question is, how bad is it going to be? We just saw what happened over in the UK. Can we see a similar crisis in the US coming soon? Now, as you may recall, last month, the UK government bond yield skyrocketed as bond prices collapsed. You remember, inverse relationship. Bond prices collapse, yield skyrocket. As a result, a number of liability-driven investment funds, let's call them LDIs, I don't know why to abbreviate that because we'll never use this term ever again, they were held by pension plans and they were literally hours away from collapse. Imagine what happens to the UK economy and the UK society when the pension plans collapse. That's financial apocalypse. That's insanity. Now, this was such a dramatic event that it actually led to the Prime Minister resigning. It cost her her job within just a few weeks after she started. I mean, that's unheard of. It actually led to the Bank of England starting to buy bonds to drive up the price and reduce yields, which means injecting more money into the system, which is not something you want to do during inflation, but you're basically stuck between two horrible options, right? You don't have much of a choice. You either let the pension funds collapse and basically, collapse the society, or make inflation worse by, propping up their prices. I mean, Both are horrible choices, and I don't envy her replacement. So, with the dramatic rise of the 10-year Treasury yield in the US, are we subject to a similar risk of what just happened in the UK? Well, the short answer, not really. And here's why. And this doesn't get discussed on mainstream media, and I don't know why. In the UK, most of the pension funds are based on a defined benefit structure, which means that your pension will be based on whatever your salary was, how long you've been employed for. That's it. If your pension plan can't afford it because they don't have the money for it, it's their problem, not yours. They have to pay you whatever they owe you. It's a fixed amount. In the US, it's a whole different system. We are capitalists. And even when it comes to pension, you eat what you hunt. In the US, most pension plans are based on defined contribution, which is a huge difference. That means that it's just a fancy term for a pension fund that has a big pile of cash, and based on how much cash they got, that's how much they divide between, the people who are entitled to the pension. Pretty much whatever they hunt, that's what you eat. So, because the US literally moved away from defined benefits pension plans to defined contribution retirement plans, at least for the private sector, it created a better defense mechanism against this sort of collapse that we just saw in the UK. Now look, the UK pension structure, where you get paid kind of a fixed amount no matter what, no matter how much money is in the pot, it created major problems for their retirement industry. Those pension plans had to create hedging mechanisms to ensure that they're going to be able to pay out the required amounts decades down the road. It's a huge, complex mechanism. Think of it like an insurance policy they got to buy for these pension plans. I mean, they got to make sure they will be able to pay it. Now, they chose to use derivatives to achieve that, but when the prices of bonds cratered and yields blew up through the stratosphere, it ruined their entire long-term hedging strategy. Now, usually, that's not even a big deal because rates go up and down, they fluctuate all the freaking time. Who cares, right? It's normal, and when it happens, they gradually adjust their hedge positions, and it's okay. But when it happens hard and fast, like it just did in the UK, it creates panic. The sheer volume, speed, and violence of that spike caught them with their pants around their ankles trying to outrun a tsunami. I mean, it's not a good race. You're probably going to lose. The speed of this spike of the yields basically caused a massive panic sell by multiple funds who were basically unloading everything as fast as they can, creating a stampede, or more accurately, a fire sale, causing the prices to drop down, lower than a limbo dance pole on my grandpa's Novigod party. And trust me, kids, you don't want to hear about that. In the US, we never had to go balls deep into derivatives and instead just, relied on mortgage-backed securities. Now, if you were around in 2008, you know how this strategy can backfire quite heavily, but this time around, it actually worked out quite well for the US. Now, if your head hurts from all that boring nerd talk, here's a quick summary. Everything I just said means that whatever happened in the UK is much less likely to happen in the US. I'm not guaranteeing 100% it's not impossible, but you would need a much bigger and much more violent kind of bond yield spike to consider something like that happening in the US. Now, look, does this mean we're all Gucci and there's nothing to worry about because of this bond yield spike? Hell no. Does this mean we should panic and run for the hills? Absolutely not. Here's what this means without all the fear-mongering and actual facts. Look, first of all, this yield spike is not the highest in history. Some experts on mainstream media are claiming such, but this is absolute bullshit. Yes, this velocity is very aggressive, but we've had other periods with similar patterns in the past, not in the last 15 to 20 years, but it happened before. Now, the world isn't ending, but there's a lot of uncertainty right now in the markets, and the yields just simply are a reflection of that. This is what's going to happen right now. As you saw, the yield is spiking. The immediate result of these high yields should be felt really, really fast in the real estate market, which already started to show signs of cooling down. Now, in simple terms, when you buy a house, you take out a mortgage. Now, these mortgages are priced by lenders based on the spread above the treasury bond prices, usually 1.5 to 2 times more than the bond rate. Why is that, you wonder? Well, if you get 3% from the government, pretty much risk-free, doing absolutely nothing, how much would you expect from a young couple buying a house, which they can't really afford because Cody and Molly don't want to live in a bad part of town where people steal catalytic converters from underneath their car? while they're actually still in it, driving. Obviously, the banks, they'll have to price mortgages higher than the treasury rate, which they can get risk-free, basically doing absolutely nothing, as I mentioned. So with this spike in yields, borrowing money for real estate is now becoming more and more expensive, slowing down demand and pushing down prices. Maybe for the first time in a long time, actually pushing some properties underwater in certain cases. However, that's just the beginning of the story. Beyond the bond market actually showing you what the market is thinking as far as, the plans of the Fed, etc., 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 beyond the real estate slowdown I just mentioned, there's a simple effect here that you should be actually aware of. As yields rise and cost of borrowing goes up, it slows down economic growth. Expensive money is not good for businesses. And as a result, the stock market eventually suffers as well. But that will be the last piece of that puzzle. So it's going to take some time. That's what I told you in the beginning of the video. It's not going to happen tomorrow. You have time, but you need to listen. Now, increased financing costs take time to trickle down to poor earnings, eventually stock multiple compression. We've already started seeing that, but that's just the first cycle. It's going to be second, third cycle. But based on current trajectory, this is where we are headed right now. Now, this is literally us paying the price for the Federal Reserve getting inflation wrong last year. This is exactly what happens when the Central Bank of the United States falls behind and all of a sudden slams on the brakes for the past few months. We have seen record rate increase from the Fed, with the third one expected just in the next meeting, and inflation is basically sitting right there smiling back at us saying, "Is that all you got, mother lover?" Now look, by having to play catch up with inflation, the Fed has doomed the US economy into recession. That's going to hurt millions of hard-working people in the process. That is inevitable, even though they won't admit it. The market knows that the Fed is out of choices. An early pivot option by the Fed would be good for the stock market in the short term, but somehow it might get even worse than a recession, since it's going to absolutely send the US into a decade of stagflation, which we haven't seen since the 1970s. And by the way, stagflation is the combination of two beauties: unemployment and high prices. Woohoo! Congratulations, right? So if rates don't go up fast enough to stop inflation, it will eventually get so bad that consumers can no longer afford anything. This will lead to reduced spending. This will lead to massive layoffs by businesses due to lack of sales and the collapse of profit margins for the companies, along with an unemployment crisis. And that will eventually lead to a very violent reaction from the stock market, just like it did in 2000 and 2008. So whatever the choice the Fed chooses, it's going to absolutely crush the market. The question is, will they choose a crash right now, even though it's unpopular, or they're going to choose the easy solution and let the market crash later through stagflation for a whole 10 years? I do not know. But there's one thing I know. During a time recession, during a time of economic uncertainty, you can still make money in the stock market by being patient, behaving in a way that makes sense, and investing correctly. There's a way to do this. This is why all the billionaires, they still make money during recessions. In fact, some of them make more money during recessions. I made a whole video. I'm going to put it right here. Check out this video. It's basically a guide on how to invest during a recession and actually make money. If you haven't yet, I urge you to subscribe to the channel right here because, we're going to need some help with the algorithm with the recession coming. And, if you watched this video and enjoyed it, I'd appreciate it. See you next video.